RateScope here, and if you've been watching silver, you just witnessed one of the most violent, most calculated takedowns in precious metals history. 22% in 2 hours, from $90 to $73 overnight on the Shanghai Futures Exchange. Western Spot currently sitting at $75, Western Futures at $76, Shanghai Spot $86, Shanghai Futures $90. That's a $10 premium still holding in China despite the carnage. Gold at $4,821. If you're genuinely learning and getting value from this work, make sure you're subscribed with notifications on. After the JP Morgan planned manipulation video, many of you messaged saying you were unsubscribed automatically or not getting notifications. That's the price of telling the truth. But the RateScope team won't stop. We'll keep bringing you verified news, clear data, and both sides of the story. Whether it's manipulation or accumulation, you'll always get the whole story here. No hype, no greed, no fear, no BS. Now let's get into what actually happened, because this wasn't just a market move. This was a war. In the last video, I told you we had no daily close above $90. I've been calling the $87-$90 zone major resistance for days. It's all documented. We tested it and rejected it. 3 candles closing below that level showed pressure and resistance building. The RateScope community knew it. We track the technicals, watch the micro and macro. We don't gamble. We plan with verified data and fundamentals. The copycats will manufacture another bank crash story or Netflix-level narrative to explain what happened after the fact. But we shared the real-time information. If you're not following on X, you're missing critical updates as they unfold. The handle on both X and YouTube is @RateScope. It can't be duplicated. That's your verification you're hearing it from the source. So what triggered this 22% overnight rejection from 90 to 73? Let me walk you through the sequence of events because this is where it gets genuinely fascinating. On Tuesday, 3 million ounces were removed from COMEX vaults. Not a misprint, 3 million ounces. Nearly 2 million ounces withdrawn from Asahi, over 900,000 ounces withdrawn from HSBC, another 282,000 from JP Morgan. 2.5 million ounces adjusted into Loomis registered. Total COMEX silver inventory dropped to 400 million ounces. That's a single-day drain we haven't seen in years. Physical metal is leaving the system. And here's the contradiction that should make every single person watching sit up straight. While 3 million ounces are being pulled from COMEX, 600 more silver futures contracts were issued delivery notices in the first 4 days of February alone, all accepted for physical delivery. That's over 3,500 contracts in 4 days, about 17.5 million ounces. Normally, 1 to 3% of contracts settle physically. Right now, we're effectively at 100% physical settlement. You can't build AI data centers with paper silver. You can't manufacture missiles with futures contracts. The world is desperate for real metal. Now contrast that physical tightness with what happened overnight on the Shanghai Futures Exchange. This is, choosing my words carefully, one of the most incredible things I believe has ever happened in the history of commodity markets in Asia. 1.44 million contracts traded on the April 2026 silver futures alone in a single morning session. That's equivalent to 674 million ounces of paper. Across all contracts that morning, 1.34 billion ounces traded, almost double annual global silver mine production in one morning. That wasn't retail panic. That was a brutal, systematic short-selling attack designed to crash the Chinese silver market intentionally. But here's what didn't happen. Prices in China remained at a significant premium versus COMEX and LBMA. Silver remained in backwardation. The paper games aren't changing the fundamentals. Then we start getting dislocation signals that even experienced risk managers are calling unfamiliar. Spot price down $9. London spot moved into backwardation versus COMEX. The EFP, Exchange for Physical, is signaling tightness in London, even as leverage is being unwound elsewhere. Regional divergence is screaming. London is currently the best bid. China and the US are deleveraging aggressively. What does that tell you? We're in a broad global deleveraging cycle where futures are being sold while physical metal is being absorbed. Metal leaving the US and China looks like speculative selling. Flows into London appear to be physical demand. That imbalance explains the current spread. This doesn't imply an immediate price rebound. Let me be crystal clear. It reflects stress in a leverage-driven system. The underlying dynamic looks like a breakdown in the neo-Keynesian, financialized market structure, with behavior reverting towards spot market fundamentals. The invisible hand is no longer operating freely. It's being replaced by visible state action, regional policies, taxation, price floors, government intervention. These aren't theoretical anymore. The Shanghai Futures Exchange just announced new margin requirements for precious metals starting Monday. Daily price limits for silver futures adjusted to plus or minus 20%. Margin requirements for hedging positions up to 21%. General positions up to 22%. They're tightening the screws because the system is under stress. Now here's where this gets really interesting. Picture this. You're short silver at $70. Then a government sets a price floor at $80. What happens? You're instantly underwater, not because of market volatility, but because of policy. There is no pullback, no dip to cover. Trading below $80 is no longer allowed. Your loss is locked in. $10 per ounce, $50,000 per COMEX contract. Margins are raised, liquidity disappears. You get a margin call or forced liquidation. And here's the part that should terrify anyone playing the paper short game. If physical silver is tight and delivery is demanded, your paper short becomes a physical obligation. No metal? You pay any price or cash settle with penalties. This isn't a normal short squeeze. This is a state-backed repricing. A price floor doesn't protect short sellers. It eliminates them. You can short paper. You can't short a floor. The moment a floor is set, the old silver market is over. Could that floor be set below 80? Absolutely. But if it's too low, metal disappears. Miners don't invest. Refiners slow down. Physical supply dries up. Then the state either raises the floor quietly, buys metal directly, or subsidizes the gap. In other words, a low floor just delays reality. The real floor isn't a number, it's where silver refuses to sell. Meanwhile, CNBC anchors are mocking silver investors because silver traded above $120 and is now at $79. But silver investors are still up 150% over the past year. Bitcoin is down 26% over the past year, and even further below its high after erasing the entire post-election gain. Yet nobody mocks Bitcoin holders with the same energy, do they? Let me address resistance and bearish factors head-on, because balance matters. This deleveraging is real. Speculative positions are being liquidated. Margin calls are forcing weak hands out. The environment is unfamiliar even for seasoned traders. Markets are sending conflicting signals because events are unfolding in stages. Clarity will only come once deleveraging runs its course and the dust settles. If we close below 73 to 74 on a daily candle, not a prediction, just a key level, we could see 70 and below short term. That's a realistic downside scenario as leverage unwinds. But, and this is critical, none of that changes. The structural deficit. The fact that 100% of COMEX contracts are currently settling physically. The 3M ounces drained in a single day. Shanghai maintaining a $10 premium despite the overnight crash. The LBMA benchmark snapshot that likely trapped Chinese shorts in their positions. The high probability that JP Morgan closed billions in shorts at the bottom. And the fact that demand for physical is accelerating. The state of Wyoming just started buying physical gold and chose a private vault over JP Morgan. That's not rumor, that's official. Institutions are waking up to the reality that traditional 60-40 portfolios don't work in this era. U.S. 10-year bonds down 50% since 2020, gold up 3 times. Current U.S. gold holdings in portfolios are only around 1 to 4%. Imagine what happens if even a portion of that 40% bond allocation rotates into gold, and then into silver. Silver moves with gold, but with industrial demand layered on top. UBS just said they believe both gold and silver can move even higher in 2026. Pullbacks this violent in a secular bull usually mark the start of the next leg up, not the end. Institutional conviction hasn't wavered. Artificially low prices created by these raids are building the conditions for a major bull market in silver because they trigger even more real physical demand as supply dwindles. JP Morgan was fined nearly $1 billion for manipulating precious metals markets. They paid the fine and kept doing it. Of course the markets are rigged. That's why you take self-custody and get out of paper. In just 90 minutes, silver was systematically smashed. Anyone still leveraging silver on COMEX or trusting paper contracts and silver ETFs needs to wake up. These instruments are designed to drain retail capital, not protect it. Forced liquidations transfer real wealth to the same players every time. JP Morgan, State Street, BlackRock, via CME, owner of COMEX. Same playbook, same outcome. Again, paper silver and physical silver are at war. Paper shorts pushed prices down 22% in 2 hours. At the same time, the physical market is being drained every day. The most telling signal is coming from COMEX settlement behavior. This is the disconnect. This is the breaking point. Let me frame what's happening in simple terms. Jesse Livermore wrote in Reminiscences of a Stock Operator that the market will do whatever it takes to prove the maximum number of people wrong. This crash just shook out. Everyone who was over-leveraged, everyone who bought the breakout at 90 without a plan, everyone trading on emotion instead of structure. The strong hands are accumulating physical at these levels. The weak hands just got margin called out of existence. So where do we go from here? I'm watching 3 things. Can we hold 73.74 as support on a daily close? If we break below with conviction, 70 and lower is in play short term. Does the Shanghai premium expand or contract from here? If it widens, that confirms the physical bid is stronger than the paper selling pressure. Do COMEX registered inventories continue bleeding? If delivery demand stays near 100% and inventory keeps dropping, the squeeze isn't theoretical, it's mathematical. The question I'm asking you in the comments: what are you expecting, 70 or below, or can we bounce here? Not financial advice. I want to know what you're seeing in your analysis. 3 key takeaways. This was a leverage unwind, not a fundamental breakdown. Physical demand indicators remain strong. Regional divergence is creating opportunities, but also extreme volatility. Plan accordingly. The paper market structure is under stress in ways we haven't seen before. State intervention, price floors, margin hikes. These aren't normal market dynamics. Do your own due diligence. I will never ask for your money, never pitch, invest with me, never run paid signals or funds. Protect your capital. Stay far away from scams using my name. If this added value, share it with one person who needs unfiltered truth over hype. The unresolved tension. We're watching a system transition in real time, from paper-driven price discovery to physical-driven price discovery. How long that transition takes, how violent it gets, and where the floor actually settles is still being written. But the direction is clear. Invest with logic, not hype. Use your own brain. Don't follow anyone blindly. RateScope out.